Hi, Will. Are you there?
I am, Richard. Hi.
Brilliant. Thank you. Hi, Will. Thanks for joining us today. It's been good to talk to you. See how you're getting on. Shall I just hand over to you to quickly do a quick intro of the fund?
Yeah, absolutely. That's great. Hello, everyone. Thanks very much for listening. So, actually, Richard, if you go back one page, always interesting. This is a real estate fund, UK Commercial Property REIT Limited. We invest in diversified portfolio of commercial real estate across the UK, portfolio of approximately £1.3 billion. And the reason for looking at that, we funded a few years ago the construction of a hotel in Newcastle, Dalata, who were in there. It's a fantastic hotel. Their occupancy rate has been great, and they've paid rent continuously to us through COVID and everything else. It's a fantastic mix of business and leisure hotel stays, as you can imagine. Newcastle. Sorry, Richard. If we go on to the overview, I mentioned a diverse portfolio, diversified by sector. We have a large exposure to industrial and logistics, and I'll probably talk about that in a minute. 60% of the portfolio, and a growing portfolio of student accommodation and hotels within there. We don't own any shopping centres or any high street fashion, which I think are difficult areas, and increasingly difficult. And many of your listeners might agree if you observe how people are using offices at the moment, a combination of environmental issues and agile working with COVID. We own very little offices. So mainly industrial and growing student accommodation, a bit of others. We have dividend yield at the moment of 6%, really strong operational performance. So our rents are growing, our earnings went up by 11% last year. But again, as I'm sure many people have observed or know, commercial real estate had a difficult end of the year, a difficult Q4 across the whole market, with quite a significant re-rating as gilts moved out and interest rates moved up. One would typically expect a decent margin over that gilts risk-free rate, and that in around autumn evaporated. So today it's a really interesting situation. We trade on a 30% discount. We offer a 6% dividend yield off current pricing. And I think we've got a really, really strong operational earnings story, rents increasing. The portfolio itself of 196 tenants, it's 98% occupied, which is good. And our rent collection was 99% last year. So again, very strong quality tenants by and large paying our rent on time. We have, as I said, a strategic focus on earnings growth. So I'm really keen with the board that we boost our portfolio, and we signed last week, which I'll talk about, some really interesting rent deals, seeing increases in rent last week of 70% on the rent tenants were paying 2 years ago on one of our industrial estates. And ESG, environmental, social and governance concerns, really, really important, I'm sure, across all your trusts, but in the built environment with real assets, physical property, the way that they're insulated, the way that they're energized, that is really important for us. And we've got quite a big focus on net zero carbon, how we achieve that with our targets, and also energy ratings similar to those that you'd have if you buy a fridge, A, B, C, D, E. But if we move on, Richard, if that's all right, to the next slide, thank you. So I'll nip through these quickly. We talked about quality income, and I probably have 4 quick stories. The existing portfolio, good bunch of names. The top 5 tenants that you can see on the screen there represent 22% of our income. People like Ocado, the government, Amazon will be familiar. Armstrong Logistics, the smaller company, great business in the Midlands in one of the UK's best distribution parks. They have a contract they manage with Aldi, very successful business. I probably expect Warner Brothers will drop down the list a little bit and be replaced with Total, following some releasing we've been doing. And in terms of growing income, in my world, I talk about something called reversion conversion. It's a little bit techie, but it's the ability to convert to cash the theoretical rental value of a property. So if we have someone, as we did, paying £10.50 for a square foot of industrial space, and we've just relet it at £17.50, which was actually ahead of its rental value, that conversion of old rent to rental value and to cash rent is what I call reversion conversion. And the table up at the top shows the potential ability to grow from a yield in the low 4s up to above 6%. On top of that, and I'll talk about them in a minute, we have a compact development portfolio, which is going to be bringing more income in there again. Thank you, Richard. If we could nip on to the next slide. There we go. And here we go on development. So developments done properly can add real value, I think, to a portfolio. And there are 4 that we have here. Collectively, I expect those to add £8.5 million of income to the portfolio at a yield on cost of 6.5%. And it's great. I mean, the fantastic thing about real estate is they're real. You can see the buildings. To the top left of your screen is a student accommodation block right beside Exeter campus. And I think it's a big advantage for students who are my tenants here that they can literally jump out of bed and in a few minutes be in their campus. So they find that tremendously popular. We completed phase 1 and it's fully occupied with around 130 students. And phase 2 is going to be completed around about March. Collectively, we've already sold 50% of the rooms here for the next academic year. So really strong scheme, very strong environmental credentials, which in that student population particularly is really important. Up on the right-hand side, this is a more complete development in Sussex, a place called Bolney. Bolney is also known for its wine production, but we don't do that here. We've let 2/3 of this to a company involved in geological surveying, and with what is happening in energy in the moment, they're really in demand. They sort of effectively use this as a data center with more people than you might have, and a third is under offer. So we expect that to be fully let very soon. And actually the rents here are around 12% ahead of the rents we expected when we embarked on this project. So that's a good news story. Bottom left, at the end of 2021, we bought a larger investment in Leamington Spa, let to a variety of people, including Iron Mountain and the NHS. It came with a smaller development site of around 80,000 square feet. And we're on track to finish this in Q1 in the next 2 or 3 months. There's smaller buildings. Again, our rents have jumped up from when we embarked on this project by around 15%, our expected rents. But here, because they're smaller, we expect really to finish them so that our tenants can come and look at them and then lease them. And the final one, and I mentioned at the beginning, branching more into the alternative sector. So anything that isn't an office, shop, or an industrial property, we group as alternatives. Student accommodation is one of those. And here we're building a hotel for Hyatt in the middle of Leeds. This isn't the most beautiful photograph, but please trust me on this. It's right beside Leeds Station in the heart of Leeds. And if anyone has stayed in Leeds, my experience has been expensive, poor hotels. So we're building a Hyatt hotel. It will have a rooftop bar. It'll be fantastic environmentally. Showers and heating are going to be electric. But actually the room rate here will be something like £95 for a room. So quite reasonable in that context. And that will come on stream later, probably around autumn 2024. So adding 6.5% return, if you like, yield on cost for all of those. Richard, thank you. If we could move on. Trying to bring that all together in a graph of where our rent might grow. So again, go back to thinking about a capital correction in value in UK commercial property happening in Q4 last year, but a strong operational performance. And this graph shows the potential in the portfolio to grow our rent by 30% from December 22, the blue bar on the left, working through the developments to the middle blue bar and up to around £90 million if everything is going on track. I should say it will never work out like this. This is a forecast. It requires everything to be 100% let. We're 98% let at the moment. So we will rent some buildings ahead of the rental value. Some will be below. We'll have some tenants leaving, but it's a trajectory of really strong earnings potential in the company, which we're really highly focused on. Richard, thank you. And just nearly finished touching on debt. Really important to be aware, UK Commercial Property REIT, with the board, we've managed debt very prudently. At the moment, we have group loan to value of 20%, and of that, around about 70%, 68% of our debt is on a longer term fixed rate basis. So we're paying 2.88% for that, so low cost. We have another facility which is flexible debt, and as you know, we all heard that Bank of England increasing their rates to 4%, so that will cost us a little bit more. But as a house, we actually, perhaps more bullish than some people, we expect that interest rates could come down. The bank will be forced to cut rates at the end of the year to around 2.5%. It's our projection, and then beyond that, stabling out at around 1 to 2%. So temporary increase on the debt, but most of our debt is on a low fixed rate cost. All our covenants fully met and managed very, very prudently. And I think my final slide coming up, if we go to the, all but one. Energy, I mentioned at the beginning, there are two things here in a nutshell which really matter for me and for the board, and I think should for anyone investing in real estate. The first is regulatory, and it concerns energy performance certificates. As I said, like when you buy a fridge or a television, it's going to have an energy certificate of A, B, C, D, E. Regulation is coming in which will require any building to be leased or sold by 2027 to be at least a C for Charlie rating, and 77, almost 80% of our portfolio is already there. So we work very hard when we're refurbishing buildings to improve them. And the leasing transaction I mentioned at the beginning, where we got a 70% increase in rent for very little money, we increased the warehouse EPC rating from an E for Echo, one of our two E's, up to B. So that was done very sensibly. The other point on this side, and again, all the companies that you look at will have this, is a goal for net zero carbon. Again, we take it very seriously if you think of the carbon produced from the energy systems in buildings. So by 2030, we expect the carbon that we control as a landlord will be zero. And by 2040, our whole portfolio will be zero. And a lot of that will be working with our tenants, whether we're putting, as you can perhaps pick out, the bottom of one of our buildings on Leamington Spa, where we have solar panels on the roof, a whole host of areas where we can improve that. LED lighting is one of the strong things that helps that particular situation. So that's on ESG. And then I think now coming to my final slide, the outlook. So I see, and as a house, we see UK commercial property in 3 stages, 1, 2, and 3. Phase 1 has happened, and that was a very sharp, in over 30 years, the fastest correction in real estate prices, commercial real estate that I've seen, brought upon by almost free money moving out as interest rates crept up, erosion of a risk-free rate, and that repricing. It was very much led by the industrial market. The industrial market was keenly priced on an expectation of strong rental growth. As we stand today, with 60% of my money in industrial, that correction has happened. So looking, I suppose, at the company now, it's a lot of that is in the price, if you like. And the operational performance of that industrial sector, for me, in the right place, a lot of money in London, undersupplied, is really, really good. Phase 2 is recovery. So operationally, we're doing well. Tenants want to lease our space. I think later in the year, should rates come down as we think towards around 2.5%, then there'll be a widening of the risk-free margin that an investor in commercial property can expect over 10-year gilts. So the sort of double positive whammy of strong operational performance, looking for earnings growth, rental increases, against a widening risk-free margin, which I think will make that capital side very, very interesting. And then phase 3, we providing the fundamentals of the real estate investments are right. Industrial, we're in the right place. I think that's good. Student market is good. We're coming into hotels. We have no shopping centres, no high street fashion, which I think is going to be at risk from people's disposable income shrinking. And we have very few offices. Offices I could talk for hours, and I won't, about, but probably one of the trickiest sectors at the moment, with a combination of capital expenditure needed to make them ESG compliant, but also companies and employees coming to grasp with agile working and what that means for demand. So on that note, I hope I've given you a quick flavour of what UK Commercial Property REIT is about.
Yeah, perfect. Thank you. So yeah, you've touched on a couple of the questions we've had that have been pouring in since you've been on. But one of them, so you expect valuations to stabilise sort of around half year, do you think?
I think we've seen the biggest shift already, and I could imagine values coming off still a little bit in March. So for me, perhaps a little bit more to come, but I have in my mind that March, which is when a lot of companies and portfolios are valued 3 monthly, March might see a little bit of a decrease. But from the point of view of UK Commercial Property REIT at a 30% discount, I'm not expecting anything like that kind of change. Yeah, and do you have any sort of cash firepower to take advantage of these valuation falls? Yeah, it's interesting. We do have firepower, but our firepower is through one of the revolving debt facility, and the money there that we haven't drawn. We will use some of that to complete our development program over a year and a half. But as rates are rising and the potential for another rise, I think in probably still to come in bank rates, I'm a little bit hesitant to draw more than I need of that revolving debt. Should we make, there are 1 or 2 assets that we may think of selling, then that might be a route in to do that. But we're being quite careful. Okay. And you mentioned just towards the end there about the offices sector. So is that not a sector that you'll be looking to grow anytime soon? So it's really, we've got a 13% exposure to that sector in a number of buildings. One is so to grow. No, I don't think so immediately. The area of the market that is really interesting is the very, very best in class offices. So people talk about brown offices and green offices. Brown offices, older offices, a lot maybe from the 80s, 90s, early 2000s, which you need a lot of money to fix them environmentally and to make them attractive for tenants. So across the country, there are probably only a handful of really top offices, and I can see companies wanting to shrink their occupational budget, pay less rent, but focusing and concentrating their budget on smaller but far better offices. And very, very few of those exist outside London. So we have one fantastic site Temple Quay in Bristol. It's not a site, it's let to the government at the moment for another 3 years. that is something we're looking at planning for, to either get planning and sell or consider developing ourselves.
Cool. So I just realised the time seems to have run away with us. So we've just got over 10 minutes. So I'll try and rattle through some of these. Quite a lot of questions on the ESG and carbon and things like that. So we'd go into those. So what initiatives do you have to improve the carbon footprint within the portfolio, and what are your targets?
So our targets are, I mentioned 2030 to reduce what are called Scope 1 and 2 emissions. So those are emissions we control as a landlord, that we can influence, and 2040 for the portfolio. The biggest way and the most important way to achieve that is electrification of heating, cooling, and energy systems. We did that very effectively. Often with buildings, they require a cycle of refurbishment. That is normal, regardless of an environmental context or whatever. And what we're finding is that by really very little extra money, we can do a normal refurbishment, but translate that into a more environmentally friendly building by introducing LED lighting, and in, say, the small office section of a warehouse, taking out gas boilers and putting in electric systems, so quite efficiently. We've had a couple of buildings where we put solar panels on the roof. Really interesting though. One of the issues we come across is the national grid not always having capacity to almost accept excess electricity that we have. So I'm sure you'll discuss elsewhere, but I think that the grid system has got a way to go before it becomes perfectly aligned there. But we're fully on track for our goals. We've had some really good successes in the way that I mentioned.
Cool. And there was a slide. I'll just go back to it. Yeah, on this one, on the tenants. Bottom one. What the tenants are responsible for. When you calculate your sort of net zero and your sort of carbon targets, is there the energy that the tenants are using and things like does that come under your responsibility or their responsibility when doing?
No, so that and that's really interesting. The top chart that you're looking at is everything that is our responsibility. So the bars are the carbon that we emit from our buildings that we control, and the blue diagonal line is the trend line. So in that case, when we go to report next year, we sold for profit an office in Birmingham to Birmingham City Council last year, and that produced a lot of carbon. So that will further improve by selling that if you like, potentially stranded building with a lot of carbon at profit. It will reduce our sort of carbon situation. To your question, the bottom chart is everything. And so we are going to be working increasingly with tenants. For instance, you can imagine Ocado, who we have as with robotic distribution systems in their warehouse. Amazon, we have an Amazon store at Wembley, London. They, as companies, will have their own net zero targets. So we're sort of looking to align ourselves there. They will want to work with us and we with them, and that's great for me. Speaking to tenants is fantastic. It's a way to reach agreements, help us increase our rent, but perhaps help them at the same time. So it's a double effort there to reach that bottom target by 2040, and I think one that's quite exciting for the industry. Yeah,
and do you get what's it like with smaller tenants who may not have the capital to be able to make improvements?
Yeah, well, one of the big wins that we get with our smaller tenants is actually measuring the data. It's quite hard to actually collect data, and anyone listening, if you try to install a smart meter in your home for your own gas or electricity readings, we're trying to do that with our tenants across the buildings, and it's not always terribly popular at the moment, probably for the same reasons that we have. So data capture is very important, and when we have a lease event or whatever, we try and put that in. We find by and large smaller tenants are either in say an office that we have in Reading, really popular, used a lot, and we control that, so we can do it there. Smaller estates, we've got a whole blend of companies operating bonded warehouses, film and media industry, aircraft industry, sun cream manufacturers. So we just speak to them and help them, but it's far easier to convert warehouses than it is, say, offices or shopping centres. We don't own any shopping centres.
Mm. Would you avoid a tenant that was a sort of higher carbon emitter tenant going forward, or would you?
No, we would work with them. We have from an ESG perspective, as I'm sure everyone would expect, we have an absolute prohibition, and this is it just seems so clear on munitions, cluster munitions manufacture, modern slavery. I'm sure all the companies you speak to would be similar. So from an ESG screening point of view, we take care there. But in terms of carbon emission, we would work with them coming into a building to make sure those emissions were controlled. So it could be electrical vehicle charging points, and again, think of warehouses with electric forklift trucks automatically going around. The provision of power for that, it's very easy to work with them in that way.
Yeah, cool. All right, let's move on to, so we've got a question here on the debt. So 20% LTV, you've always had a really sort of low LTV. What's your philosophy then? And did you anticipate higher rates? Is that why it's always been historically quite low?
Historically, we have always run ourselves on purpose with a lower debt, offering, I suppose, less risk than perhaps some other companies from that point of view. So on purpose, a lower risk proposition, and in this environment, that's coming in as a very good point. So the two things there in debt, low 20%, with the falls in value we saw in Q4 and an expectation to spend money over the next 18 months on development program, I could see the LTV perhaps going slightly above 25%, that sort of level. But again, the majority of it is at a fixed rate. So that's our debt position. Yeah, happy with that.
Cool. And you've mentioned throughout about you've obviously got a massive weight into logistics and industrial and logistics. Do you think the sell-off in logistics companies and things like that, do you think that's been overdone? Obviously, you mentioned rental growth in that sector still coming through, and demand and supply still being favourable. How do you see that sector playing out?
I think so. With not all industrial or logistics is good. It comes with the proviso that investors have to understand the location. I have to, and I do understand the location. So if the property, if the warehouse, the estate is in a good location and is offering what tenants want, then the operational side, the occupational side is really good. And I gave an example of two lettings we've done very recently at our estate on the M25 at Radlett, where we achieved a 70% increase in the rent the previous tenant was paying from 2 years ago. And that actually is not a top rent. It's almost a value for money rent, even with that big increase compared to some more central London locations. So it works really, really well in this environment. Yields on top quality industrials became very low last year, probably around March, June last year. Based on that rental growth prospect and low interest rates, they needed to move out with the correction in interest rates. And it probably came into an environment where at the end of the year, and thinking of valuers and how they look at valuing these assets, most sellers would be motivated sellers. There would be a reason, whether it was from redemptions from various funds, and of course UK Commercial Property closed-ended. We don't have that. So motivated sellers meeting buyers whose cost of capital, cost of debt had dramatically increased. So that created that situation where there was a strong correction. For good stock, operational story very strong, but for another yield movement, I don't see yields going back to where they were when interest rates were sort of 0%, because I don't see that 0% interest rate environment coming back. I'm stabilizing at 1% to 2% in a few years' time. I think there will be the potential for yield re-rating, a more mild one, but it needs a move in gilts and for me a move down in interest rates, which we expect at the end of the year.
Cool. Yeah. And then just to sort of round off on your developments, I found that quite interesting. Let's go to the slide here. Yeah. So how much of that is how much of the portfolio is in developments at the moment?
It will be it's less than 10%.
Okay. And is it what's the reasons behind that? You don't want the risk. Like would you take that higher, or is 10% about right?
So I think that there are 2 points in the market that we had for the last few years. Funding a developer, which is a large piece of this to develop, offered a way into better quality stock. We get a finance return on the money that we spend, but that finance return is not treated as revenue, as income. It comes off the final capital payment. So today, I suppose in an environment where I'm investing, I'd probably prefer to invest in an asset that was immediately income producing. So our hotel in Leeds will be finished for example, in let's say July, August 2024, which I think, by the way, will be a really interesting time as we're hoping for stronger economic growth. And I'm expecting a lot of people to be wanting to stay there and use the rooftop bar. But when that finishes, we have to wait from now till then to get pure rent, pure earnings. So from that perspective, I wanted to control the amount of development that we undertake, and make sure we're not overcommitting ourselves in that direction. Yeah, fair enough. Cool. Okay. All right. Well, I think that brings us to the conclusion. So thanks a lot for coming on today, Will, and very interesting to hear about. Great to speak to you. Thanks, Richard. Cheers. Bye. Right. So we have a few dates there for future shows. Still got 17th to be filled, but there's what's coming up, and we hope to see you again next week. Thank you for tuning in. Cheers.